So the unquestionably strong information paper was out yesterday, I think, as you would all know. The impact, both in terms of quantum and timing, is broadly in line with what we had factored into our forecast. So we haven't made any material changes to our cash EPS forecast for any of the major banks as a result of yesterday's announcement. Now, I think the key surprise for us yesterday was the definitiveness of the announcement. So APRA clearly has now taken a view on where international rules, or aka Basel IV, will end up, and consequently they've taken a view on where ultimately capital requirements for Australian banks need to be. So that clears up a lot of the uncertainty that had been hanging over the sector now for some time. Much of the bearishness in relation to the banks had been in relation to the uncertainty about the capital outlook, and the big bears had been talking about much chunkier capital raisings or chunkier increases in capital requirements than yesterday's paper has indicated, and I think that's why share prices have responded quite positively. Our base case remains that outright capital raisings won't be necessary and that dividends won't need to be cut. In the case of ANZ, they won't need to raise any capital at all. The release of capital from the runoff of the institutional loan book and asset sales should be sufficient, and more than sufficient, in fact. So we continue to have a buyback for ANZ in our FY19 numbers. Having said that, there's now increased scope for ANZ to potentially conduct that buyback earlier than FY19. Westpac, we think, can meet the requirements. We continue to expect that they can meet the requirements through undiscounted DRPs. So if they get 10% take-up rates on their DRPs, that should be enough to get there. NAB and Westpac, we think, will need to run at least a series of 3 discounted DRPs such that the take-up rate is 30%, and that should get them there. Now, in the case of NAB and CBA, if they continue to undertake risk-weighted asset optimisation initiatives, or continue to shrink their institutional loan book and or embark on asset sales. And you might note that there is speculation in today's AFR that CBA is looking to sell its life business. That can alleviate more of the pressure on their DRP situation, and they might be able to get there through undiscounted DRPs, or a lower number of discounted DRPs if they do embark on any of these initiatives. Now, look, overall on the sector, we still remain positive. So despite the rally yesterday, we still see further upside to share prices. We think the impetus for institutional investors to increase their portfolio weightings has now been brought forward. So it seemed to us that there were enough institutional investors that were waiting for chunky capital raisings that they were planning on using to increase their portfolio weightings to the banks. But with that scenario now, with that now being a lower probability scenario, they'll probably consider increasing their bank weightings now. So that institutional demand I expect to strengthen. At the same time, I think the retail demand for bank shares will strengthen because there's more clarity now on that dividend outlook that I just spoke about earlier. On earnings fundamentals for the sector, we expect NIMs to expand going into the next half. And although we are expecting investor loan growth to come off a bit, we think that will be partially offset by increasing owner-occupier loan growth. On asset quality, we expect asset quality to generally remain benign for at least the next 12 months. So we are pretty positive on the sector at current share prices. Westpac continues to remain our preferred pick. We think that's offering the most compelling upside.